Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. Really appreciate you being here with us today, and certainly really appreciate a lot of our faithful followers and listeners. Really appreciate you tuning into every episode. Thank you for providing us with some great feedback in terms of the guests that we brought on, the content that those guests are bringing to us. I have another amazing guest with me today, Michael Parks. Michael, welcome to the show.
Thank you so much. I really appreciate the opportunity and looking forward to talking with you.
Yeah, absolutely. Likewise, you've got a pretty extensive background in real estate in a number of different areas. So definitely looking forward to diving into some of those topics. For my listening audience, Michael's mission is to help busy professionals find their path to wealth. Through the Navigator Wealth Fund, Michael is helping clients diversify their portfolio with high quality real estate and private money loans so they can retire confidently. That said, Michael, maybe you can kind of help us learn a little bit more about, how maybe you first got started into real estate and what you're currently focused on.
Yeah, sure. So I got started, investing in multifamily myself. Actually, the first one I did was actually a rental property that was a ski house. I think a lot of people who start to have enough money to do that type of an investment say, hey, wouldn't it be great if I just bought a vacation home and rented it out, and then it would pay for itself, and then I'd get to use it, right? So I did that for a while, and it turns out that I liked using it a lot more than I liked renting it. So I really enjoyed skiing, and I did some renting, and it deferred some of the costs, but it certainly wasn't a real great investment in and of itself. But then I went and purchased a number of multifamily properties on my own in Massachusetts. I live in Boston, Massachusetts. And then I was working I'm an IT professional, but I was working for some real estate investment trusts. And that's where I really learned about the big business of real estate and how you do it as an investment professional. And so during that's where I learned also about syndications and funds and all of those sort of things. And so with that, I became a real estate syndicator, and most recently now launching the Navigator Wealth Fund with my partner, Jeremy Lemire. And on the Navigator Wealth Fund, we are bringing a whole bunch of different opportunities, both for ourselves and then also for investors that like to invest alongside of us.
That's great. That's quite the journey there. So it really kind of got started in, went from vacation homes into the multifamily space on the active side, went kind of on the REIT side, which definitely interested to explore a little bit more about your background there as well. And then you kind of ended up in the place that you're at now, which is primarily in private placements or syndication. So for my listening audience that might not be familiar with private placement, would you mind explaining to us a little bit more about what that entails and why private placement investing differs from other types of real estate investments?
Sure. Yeah. So I think, there's a few different ways to buy real estate at a high level, right? One way is you go out and you purchase the property yourself, right? That's easy to understand. Everybody understands that. Another way to do it, which would be through a Wall Street type of a product, is a REIT, a real estate investment trust. And so really you're buying that like a stock. And when you purchase shares in a REIT, you're basically purchasing a portion of the properties that are in that REIT, and you get, your proportional share of those properties. That's a REIT. And a private placement kind of sits in the middle. It is similar to a REIT in that it's a group investment. So it's a group of people pulling their funds together and purchasing what's usually a much larger property than maybe individuals would be able to do on their own. And so it's similar to a REIT, but a big difference is it's not publicly traded. So there is no, Wall Street being able to liquidate your shares, buy, sell them. You really have to get to understand the sponsor of that private placement, get to know them, and then invest with them into this pooled or group investment. And so that's what I do is I pull these people together that want to invest in real estate and do it in assets that they can't afford on their own, and do it as a group.
Yeah, absolutely. So, I mean, at the end of the day, the commonalities are the investor is still acquiring shares in the investment. The difference is through a REIT, it's a publicly traded share, and it's subject to the market fluctuations, really on Wall Street. Whereas with private placements, you're still a shareholder within that syndication. The difference is it's not a publicly traded share of stock, rather it's a private or private placement share. Am I saying that correctly?
Yep, you said that very well. And then, I guess the other thing to note is that why would you do that? Why would you do it in a private group as opposed to a publicly traded? Quite frankly, the returns are a lot better. So
Hmm.
when you're dealing with a REIT, they're very expensive to set up. They're very expensive to operate. There's a lot of very large buildings filled with people that operate them. And ultimately your returns just in round numbers, if every REIT's different, but if a REIT is 4 to 7% return, you can easily get double that in a private placement because you're investing as a small group. You're getting a bigger portion of the profits coming back to you.
Yeah, a couple of other differences, and you can maybe help me kind of articulate this or confirm. And that is with a publicly traded REIT as an investment, there's really no equity upside to the investor directly when that opportunity sells or goes full cycle. And then, second to that, there's no tax benefits. Am I saying that correctly?
Yeah, so I would say that they're very different, and I'm not a CPA or an attorney, but basically with REITs, so with a private placement, there's usually a very specific exit plan. You purchase the properties, and at some point they're supposed to be sold, and that should be all disclosed up front. And when they're sold, then you get a portion of those profits, and that's quite frankly a big way you get those higher returns is that the property is having value added to it because maybe you're doing renovations or things like that. So with REITs, there's actually not usually a lot of sales of REITs. They tend to be buy, hold long term, and everything gets kind of evened out and spread across everything in the portfolio. So you don't tend to see those higher returns that you get on a sale. The tax benefits that you mentioned, one of the great things about that private placement is that just like when you purchase a property yourself, it depreciates, which is that paper losses because the building degrades and the government lets you take those losses against your earnings. And so because of that, you get some great tax benefits. You get the exact same thing in a private placement that flows to this group of owners, and REITs are taxed very differently.
Yeah, that makes sense. Now, let's talk a little bit about, if you don't mind, you had originally gotten started in real estate investing by purchasing a vacation home, which I believe you mentioned you didn't really use it. You used it a lot as a vacation home yourself, maybe less as a rental property. I have a lot of investors that oftentimes want to do the same thing, where they want to purchase a vacation property in a real nice location that they can go to and spend time at with their family. And they look at that vacation property really also as a business, because during the time that they're planning on not utilizing the property, they're going to rent it out to a tenant, right? They might hire a third party property management company to manage the asset when they're not there, clean the unit or property, as it's being turned over. Why would you maybe recommend or not recommend that people consider deploying that strategy, as really a way to earn passive income?
Yeah, so I would say that it kind of comes down to numbers. First of all, if you like the vacation home and you want a vacation home there and you want to use it, you should go buy it, right? if that's what you want to do. I loved it up there in our skiing in New Hampshire, which is where my place was, and that's a great way to do it. But if you look at it purely from a numbers perspective, in terms of what kind of a return on your investment you will get, if you were to rent it all the time, it might make you a decent return. Maybe a lot of them won't, to be honest, right? And you have to a vacation home's not a vacation. All depends where it is, how much it costs, how much the rents are, how popular it is. But what you'll find in many of them is they're usually seasonal, whether it's skiing or whether it's in an island in the winter is popular, but not in the summer. Florida's too hot in the summer, right? So when you start looking at occupancy, it's oftentimes it's seasonal, and you'll be surprised, but it won't rent every day, right? It's not like a multifamily property where you got a year-long lease and it's full. You're going to find that somebody's booked 3 weekends and now all you have is midweeks left. Well, isn't that much demand for midweeks, maybe even in the high season. So your occupancy percentage, when you look at your numbers, is going to be significantly lower than what you probably would expect, and certainly lower than multifamily. Adjust it seasonally, and just know that, hey, when people scoop up the weekends, you could be stuck with the midweeks. If you can rent it by the week, great. Some areas are set up well to do that, but others, if you don't rent it all the time for 2 night minimums, you're just not going to get many rentals or as many as you want. So look, the return. So my view is I would rather invest in something that makes a really good return, take the money from that return and do with it what I want, whether that's go on vacation to these vacation houses or buy one that I enjoy using. But remember, you're always going to want to use it when everybody else wants to rent it. So it's one or the other.
Yeah, yeah, absolutely. Now, I know that you've been involved in investing in other types of asset classes, even outside of your traditional, we'll call it Airbnb type properties or multifamily. Can you break down maybe for our listening audience the different types of real estate assets and how investors should approach them based upon their own goals and risk tolerance?
Sure. So when we talk, we deal with a couple of different asset classes today. We have multifamily. We also do self storage, and we do build to rent and some development. So build to rent is part of development as well. And so when I think about those, multifamily and self storage operate fairly similarly right now. At the end of the day, you're renting a set of square feet within the building or within the complex, right? There's a lot less tenant needs and things like management in the self storage, but it's not nothing. Self storage is still an active business. When people don't pay, there is a lot of work to be done to make sure that the building gets secured, that the contents of the self storage are protected by whatever the laws are. They're different by state in terms of what can be done with that when the tenant doesn't pay. Collecting, you still got to do plowing. There's still a whole bunch of self storage things that maybe you don't think of unless you've been in the business. But I would say both of them are very hot right now. There's a lot of demand for both self storage and multifamily. And because of that, the prices for both of those are high. So finding a deal is challenging. And then in the development and build to rent, that area, still is I think, a good area to get particularly good returns right now in today's market. With that said, you know, there's some challenges between inflation costs that are driving up the cost of doing the building, just the materials themselves. Even though it's eased, it's still elevated. And then the other piece is the interest rates. So interest rates being much higher, and that affects all real estate, but it particularly impacts anything that's development. So one of the challenges with development that if you haven't done it before is loans are not as easy as stabilized multifamily properties. So stabilized multifamily properties, you can go out and get, Fannie Freddie type loans. You can get 80% loan to value. You can often get renovations covered, and you can get some pretty good interest rates. When you're dealing with development, there's inherently more risk with development. And so what you're going to find is that loans are going to be more like 60, 65% loan to value, which means you need to bring a lot more capital to the table to do those types of projects, and your interest rates are going to be higher. So that's getting a whole financial side. But as an investor, which one should you do? I think it depends in what your goals are, right? And so if you have the ability to be a little bit longer term, you're looking to maximize your returns, maybe kind of what we call in the building wealth phase, then you're willing to take some more risks around doing development and those types of things. If you're much more into, I need cash flow to live on, I have a certain nest egg, I'm tired of getting 4 or 5% in bonds or in CDs, and I want to get 10 or 12%. Then in that case, you probably want to look at something multifamily self storage, or what we really like right now is private money lending. I can probably talk a little bit more about that, but by private money lending really reduces your risk compared to actually owning the building. You're basically lending into the building, and you can get some returns that are significantly better than you might expect. Maybe just a little bit less than the people who are buying the buildings with equity, but with a lot less risk.
Yeah, no, that's great. I really appreciate you highlighting, the goal of, diversification and having that kind of, well balanced portfolio based upon what your own personal, investor, goals are, and what your own personal risk tolerance is, to those investments as well. But you brought up private money lending, so maybe you could kind of help educate us a little bit more about what private money lending is and how our listening audience might benefit as a direct result of using that strategy.
Yeah, sure. So, I mean, what we've been talking about so far is investing into real estate. So, buying the real estate and having ownership in it, however you do it, whether it's a syndication or just going out and buying yourself. Almost all the time, when you're doing that, you're also getting a loan to purchase the property. So, if it's $1 million property, there might be $200,000 of equity being invested in it, and then $800,000 that's a loan from a bank, for instance, or from what's called agency financing, Fannie or Freddie. Uh, and and for stabilized property, that is definitely the way to go. I mean, those are good options. Bank loans, Fannie Freddie loans, they're great. The thing is that there's a lot of projects that have good returns on them that just don't qualify. If you don't have 90% plus occupancy in the building, or you have a major renovation, or maybe it's not occupied at all, it's very much harder. You won't get agency financing, and there's a lot of banks that maybe used to lend on it, but that number of banks has dwindled significantly in the last year. Banks' liquidity has gotten tight, and so just going to a bank to get a loan is no longer an easy thing to do on a project that doesn't fit exactly their box of occupancy and all the other things that they're going to look for. But that doesn't mean it's a bad project. So there is the opportunity. And I think that's the real sweet spot right now for risk adjusted returns. So people who have those projects come to myself and Jeremy and the Navigator Wealth Fund and say, we can get a bank loan for, so much money. Let's use our example. Instead of that 800,000, we can get a bank loan for 600,000. We want another 200,000 in a loan. Can you do that? And we can, right? So we go in and we add another $200,000 loan that sits behind the bank loan in terms of where it stands in the capital stack.
Mm-hmm.
But it's going to be at a much higher interest rate. So if the bank loan might be, let's say, prime, 8.5, this could be a loan at 12%, for instance. And we pass a lot of that increased interest rate that we're able to charge the project for the loan on to our investors. So our investors can make a pretty good return. The last loan that we closed a few weeks ago, our investors are expected to make 12% on their investment. and they are sitting in a capital stack position where they get paid out right after the bank loan, but before any equity gets paid out.
Yeah.
So if you think about when the project terminates or they sell it, your risk position is very low because you're sitting right behind the bank and before any of the equity, and yet you're getting a 12% return, which is pretty close to an equity level return, but in a much better risk position.
Yeah, that makes sense. Now, I would suspect that you have a pretty strict way that you evaluate potential operators that are looking to have you deploy capital into their projects. What would that typically entail?
Yeah, I mean, the first thing is we like to work with operators that we know well, or ones where we are actively involved in the project in some way as well, right? So that's important to make sure that we are able to influence the outcome of the project, even though the risk is in a much lower risk position than equity. We want to protect everybody's money, right? We want to make sure that the sponsor is able to drive the project through to completion. And if things start to go wrong, we want to be in a position where we can influence that and make it come out right. So that's number one is betting the sponsor of the project, or in this case, the borrower of the money. And then the other thing we look at is the loan to value ratio. I mentioned that earlier. That is the other key metric. Um, there are some lenders out there that will lend 90. Some of them will even say, I'll loan 100%. Um, that's uh, that's not a great risk position to be in, but there's plenty of opportunity to be in the under 80% loan to value, which still gives you a lot of protection should things go wrong on the project. The people who take the hit on that are going to be the equity owners in that project, and not the lender. So loan to value and knowing the sponsor or being able to be an influential part of that sponsorship team that's borrowing, those are what we look for as the top two criteria.
Yeah, that makes sense. Now, just kind of looking forward in the real estate space, based on your kind of experience and expertise, what future trends do you predict in the real estate market, and how might investors prepare?
Yeah, I mean, I think a lot of people are anticipating interest rates coming down, and that's one of the biggest factors I think going on in real estate in general. And so I do think that when we see interest rates start to come down, maybe later this year, maybe early next year, we're gonna see that the market gets hot again. So I would say, particularly when you think about multifamily, I put self storage in the same area. Um, it was, I don't want to say overheated, but people were overpaying for the assets, in an expectation that rents would continue to rise and that they would eventually get caught up, and it was the only way to get in. And even though the prices haven't come down because of the interest rates, a lot of the volume of transactions has slowed significantly. And as soon as we see the interest rates starting to head down, I think we're going to see transaction volume heat up and prices remain high, maybe even go higher. So, you know, what do you do with that? Do you get in now or do you wait? I think the opposite would happen if interest rates actually went up. We're going to see things get very cold very quickly. So I don't think most people think that's going to happen. I think everybody thinks we've seen the top of the interest rate market. So I would say now's a good time to be underwriting deals. A good deal is a good deal, and you probably have a better shot at doing it now than you will finding one now than you will in 6 months. The trick is finding somebody who needs to sell, and and now's a good time to do that. In the meantime, I love the private lending space. That's a way to make your money make money. That is still out there, and that is going to get even hotter as time goes on. As there's more transaction volume, there's more need to borrow. So I do like the lending space over the next year.
Yeah, Michael, that's a great outlook there. And I would suspect even if interest rates stay where they're at today, or even potentially, progress upwards. I know nobody's really talking about that potential, but of course that potential does exist. That interest rates, stay relatively flat or even tick up a little bit. That we might see some further transaction volume picking up as a direct result of sponsors that are experiencing experiencing some financial distress, right? So there's always that possibility also.
Yeah, that's right. Certainly, there's a lot of loans that are going to come due, have been coming due, and will continue to come due. We're seeing it in the commercial office space. I mean, that's an asset class we don't play in right now. Uh, but certainly there's distress there, and that would happen in multifamily as well, in if interest rates go the other way. The other thing that happened just trend wise is during the pandemic, we saw a lot of migration out of the gateway cities. Big cities move to the suburbs, also move to warmer states. A lot of migration from people up here in Boston, where I am, out, right? New York, out, move south, move into lower cost living, move into better weather, all of those things. I think we've seen the end of that. I think we're going to start to see that reverse, and so now is a good time to be thinking about if you want to own gateway city assets, if you want to own premier assets. Now's probably as good a time as any to start looking at those gateway cities. And meanwhile, we're going to see some, and we have seen some vacancies starting to increase in some of those areas in the South, not so much because of migration out, but more so because of overbuilding. And the migration just didn't continue into those areas at the pace that buildings were going up. I think that's a 18-month blip because all construction pretty much stopped that wasn't already in motion about 12 months ago or so. So just because of interest rates and inflation. So that will correct itself.
Yeah, absolutely. Time definitely has a way to kind of heal all wounds and really push everything back to the mean, so to speak. So as far as Michael Parks goes, what's really kind of next up for you on your bucket list? Do you have any goals for the balance of 2024, either personally or professionally?
Yeah. So for professionally, for what I'm looking to do with Jeremy with this Navigator Wealth Fund is we want to put in more and more deals into it. So we're looking to have up to 3 more deals available this calendar year. Because we want to always have something really great to offer investors to invest alongside of us, and we always invest our own money in these deals as well. So a couple of things coming. We've got another private money loan at 12%, could be 14% with a $750,000 minimum. That'll be coming up in July, August. We also got a fix and flip pool that is, again, private money lending, but it's in a pool of fix and flip single family resources. We've got, and the third thing that we have in the works, we already own the land on it. It's a build to rent community, small build to rent community with duplexes that are highly efficient in terms of how they're being built, which is probably this whole other subject. We've got a strategic partner, Dr. Lee Newton, who is very keen on how to make a super efficient building, both from a construction standpoint and from an operating standpoint in terms of being green and low energy costs and those types of things. So we're excited to take his prototype and start duplicating it on another piece of property.
No, that's great. When we jump off the line here, we'll talk a little bit about an investment that I made in a accessory dwelling unit company by the name of Boxable. Maybe you've heard of them, maybe you haven't. So,
Yep.
um, with that said, Michael, what would be maybe one or two different ways that our listening audience could connect with you to learn more about what you're up to?
Yep. So best way is going to be my website, navwf.com. So Navigator Wealth Fund, navwf.com. You can get to me through there. My email is michael@navwf.com. And I'm mostly on LinkedIn from a social perspective. So anybody can grab me there. It's Michael Thomas Parks on LinkedIn.
That's great. That's great. Well, Michael, we really appreciate you joining us on the show today.
Wonderful. Thank you so much, Jeremy. I really appreciate you having me on and look forward to connecting with your audience.
Absolutely. And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.